Less than 10% of the car market in the US is occupied by electric automobiles, and with governments and judicial systems pushing for more EV adoption, the EV market share should skyrocket from its current levels over the next few years. Therefore, a business like Rivian, an EV producer who just reported Q3 numbers, could potentially be the investment you've been looking for as long as you're interested in gaining that EV exposure. They haven't been able to turn a profit as of yet, but Tesla also struggled initially while production ramped up. So could this also be the next big thing, or should we be leaving this stock for the hedge funds? Make sure to stick around to find out as we talk about all that and more in today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we'll be analyzing Rivian's business and fundamental results, and once we've provided an analysis on this business, we'll use our findings in combination with our intrinsic value calculator to put an evaluation on this business to see at what price point we should be buying this stock. And if you enjoy this type of content, make sure to subscribe as we post on here regularly, analyzing the businesses you're most interested in as we look for value investing opportunities. So make sure if you have any video recommendations, drop them in the comment box below. But with that being said, let's jump into the video. Alright, so today we will be discussing Rivian's business. Let's go through the key highlights to start off with. And for this quarter, they had 114,000 new R1 net pre-orders in the US. And so their R1S is the world's first electric adventure vehicle, and it's starting at $78,000. Okay, so 114,000 have been pre-ordered now. They've also made sure that you're aware that their partnership with Amazon entails 100,000 electric delivery vans, and that they were able to produce about 15,000 vehicles since the start of their production. This is actually a 67% increase quarter over quarter in production. So they're producing way more vehicles right now. And I can tell you it's definitely needed, especially if they're going to fulfill all these orders here. And the last bit about their key highlights here is that they're still on track to produce about 25,000 vehicles in total for this fiscal year. Okay, so if we take a quick look at what management has produced for us here, they said that they produced about 7,300 vehicles and delivered 6,500 of them this quarter, despite their currently challenging supply chain environment, and that they've been able to gain some logistics cost savings from using railways to deliver their vehicles, but that they expect that in Q4, with the increase in volumes as they ramp up production, is probably going to cause a larger discrepancy between production and deliveries. All right, and if we take a look at the business outlook, we can see their core focus remains on ramping up that production. Okay, they're confident that they continue to do this with the systems, equipment, and team that they have currently in place. However, they believe that the supply chain constraints will continue to limit them going forward. Additionally, they expect their R2 platform will launch in 2026, and they expect that this platform will unlock a global market opportunity for Rivian, and they are excited about the early development that they've seen so far. Lastly, they say they remain confident in their ability to fund operations with the cash on hand. They do have about $14 billion of cash on the balance sheet. We'll get to that in just a second. And all that cash excludes the impact of the investment in their joint venture with Mercedes-Benz. Again, we will touch on that in just a little bit. First, I want to go through the numbers here. Okay, as you can see right off the bat, if we do a quick year-over-year comparison, we can see last year they had gross profit of $82 million. Actually, that's a gross outflow of $82 million. Now it's at a point where it's gross outflow of $917 million, okay? Mainly because they have actually been able to massively improve their revenues here, right? $536 million they've actually been able to achieve from their orders. But on the contrary, they're spending $1.4 billion in order to produce those revenues. So we're definitely scaling in the wrong direction. They're also still spending a considerable amount on research and development and SG&A as well, especially when you compare that number to their revenues that they've been able to produce. Ultimately leaves us with $1.7 billion of losses from operating this business. All right. And if we look at this from a 9 months perspective, we're actually at $5 billion in losses from operating this business. Not looking good. We're bleeding a ton of cash. And here's the other kicker, right? We had 101 million shares last year. Now we're at 918 million shares, meaning they're severely impacting and diluting their investors. But the flip side is they do gain some monetary value from that. So I'm sure investors aren't too angry since this business is definitely going to need the cash. Okay. Let's talk a little bit about something else here that they're doing. Stock-based compensation expense. We can see for this quarter, they had total stock-based compensation of about $293 million. Overall, for the 9 months, it's $852 million. Okay, and they say this stock-based compensation expense has increased throughout this year as a result of the bonus compensation for 2022 annual performance incentives, meaning they're actually rewarding themselves for their performance that they've made so far, despite absolutely leaking cash out of this business. I don't know about that, but that rubs me the wrong way just a little bit. I understand that revenues have increased, but costs have increased by such a significant amount. It's not really indicative of a performance incentive. And then we get down, the news gets a little bit worse. They actually had a huge recall back in October where they had to recall more than 12,000 of their vehicles due to a technical issue with their seat belts. And considering this is a business that has only produced about 15,000 vehicles so far, that's nearly all of their vehicles that had to be recalled. And the stock dropped 8% because of that. But with that being said, let's at least talk about their liquidity. This is actually in good standing here, guys, because they have $18 billion in cash with only $1 billion in debt. So the liquidity looks very nice at this point. No issues on the balance sheet. That is one bright side at least. And that's why they're confident they can use that cash that's on the balance sheet to fund their operations going forward over the next few years. Finally, let's go through the free cash flow statement. We can see free cash flow that they've been able to produce over the last few quarters. Last year, $1.1 billion in free cash outflows. Now it's about $1.6 billion in free cash outflow. Again, if we look at this from a 9 months perspective, about $4.7 billion of free cash outflow. I mean, what can they really do with that? Well, when we look at this from their financing activities, well, it's what you'd expect, and it's where all this cash is coming from. They're diluting shareholders, and they're also taking out convertible notes. So just be mindful of that. That was in 2021. 2022, yeah, nothing really to note here. And that leads us to the deal with Mercedes that I alluded to earlier. And that's that they forged a deal with Mercedes on jointly operating a manufacturing facility in Europe, right? And so that partnership, along with the partnership with Amazon, are the two things investors are really getting excited about here with this stock. I know top line and bottom line do not look that amazing, but we'll have to see over the next few quarters, especially once supply chain constraints have been lifted and this business is able to make deliveries as they project to into the future, how this business turns out, especially on top and bottom line. Now, with all of that being said, it's time for us to evaluate this business to see at what price point we'd be comfortable picking up shares of Rivian for a margin of safety investment. As you already understand by now, they don't currently have any profitability or free cash flows that would help us project out into the future. But if we assume that for the next few years, they're not able to produce any profitability, but that by 26, especially once their R2 products start rolling out and we see more sales in this business, that they're able to produce about $1 billion in operating income. And if we require a 10% return, we don't expect them to pay a dividend, at least not to start off, and that they're not able to grow for the first 5 years, into 2027, let's say, and then by 2026, 2027, they start to grow at, let's just say, 25% per year on a 30 PE, the stock should be worth about $34 per share. The stock is currently trading at about $30 per share after the 5% pop after hours. So we're almost fairly valued if you believe in this kind of growth scenario here. Now, in the very best case scenario where production actually is able to ramp up without any supply chain limitations, they start to take on more R1S deliveries, they really start to benefit from a rebound in the economy, people start to spend more, etc. And we'll just say it's still relatively slow growth for the first few years at 5%. But then again, once we get to 2026, 2027, around then, we really see a rebound in their fundamentals. They're really able to grow margins and market share, etc. They can start to grow at 30%. And let's say it's on a 45 PE. Yeah, the stock could be worth about $76 per share, so more than a double from where we currently are looking at. But in the very worst case scenario where this business continues to struggle, more supply chain limitations, we have further growth in their fundamentals, of about 10% because cash just continues to leak out of this business. But then, by the time we get to 2027, they've leveled out at about 0% growth. On a 25 PE, the stock would only be worth about $7 per share. And I mean, $7 per share looks terrible, but when we zoom out on the stock charts, we can see they haven't been able to get below, like $25 per share as the stock is being propped up. So there are some investors in here thinking that this can go higher and they're really holding the stock up. But at the end of the day, that's really what it comes down to, is your belief in this stock. Are they going to be able to become a profitable business like Tesla was able to and really scale up their production and gain market share in the EV space? Or are other businesses like Ford, GM, and potentially even businesses like Apple going to come in here and take over that market share that Rivian is looking for, at least in the EV space? That's something we're really going to have to see over the next few years. But with all that being said, that is the analysis for Rivian Automotive. If you enjoyed it to this point, make sure to like and subscribe. It really helps out the channel. And let me know your thoughts on this stock in the comment box below. And with that, I'll see you on the next one.